You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. OIC offers a variety of resources to those interested in learning more about options, including live seminars, webcasts, and podcasts. Check out www.optionseducation.org for more information. Now here's your host, OIC's Director of Retail Education, Joe Burgoyne.
Welcome to OIC's Wide World of Options. Thanks for joining us for today's show. Let's get started with industry happenings.
It's time to get a handle on the latest developments from the world of options. It's time for Industry Happenings.
Today's Industry Happenings focuses on a development in the options industry that few thought would be possible: new option exchange trading floors. One new floor has recently opened, and one is promised to be on the way in the not-too-distant future. In late April, the NASDAQ PHLX, which is the Philadelphia Options Exchange owned by NASDAQ, opened a new trading floor and facility in a brand-new building in Center City, Philadelphia, bordering the University of Pennsylvania and Drexel University. The NASDAQ is clearly making a large commitment to its team in Philly, who are now responsible for 6 option exchanges after the acquisition of ISE last year. Now, there's a long history when it comes to exchanges in Philadelphia, obviously long before options were traded on the floor. The first exchange in Philly dates back to 1790. Now, with the new commitment from NASDAQ, it looks like there'll be a long history ahead for trading floors in Philadelphia. The other exchange promising to open a new floor is the Box Options Exchange. Plans are being finalized for an open outcry trading floor to open in Chicago. No firm date for this opening as of today. Well, that's the latest in a surprising industry happenings.
It's time to break down the latest option strategies. It's time for Strategy Spotlight.
Joining us today on Strategy Spotlight is a Chicago Renaissance man, Dan Passarelli, founder of Market Taker Mentoring, bass player, and foodie. Yo, Dan, thanks for joining us today.
Joe, thanks a ton for having me. I appreciate it.
Hey, man, always great to talk to you, and I know our listeners appreciate your wisdom. You've got a lot of experience in this business. Before we get into today's topic, why don't you just, tell the listeners a little bit about your background?
Sure. I started down on the trading floor back in 1993, worked my way up from runner to clerk to market maker. and I was a market maker down on the Chicago Board Options Exchange floor for a number of years in the equity options. Then got into the education side of things and found that was really my passion. Started market taker mentoring about 9 years ago, and we've trained over 2,500 retail and professional traders since then.
That's awesome. Oh, man. So it was really the passion for teaching that drove you to start market taker mentoring?
Yeah, it really was. I mean, I guess I sort of had a very different path than I think a lot of people have. My first trade that I ever made in my life in options was as a professional. I didn't kind of start with the basics and work my way up. My first trade was in the SPX bit. So
you weren't messing around.
Yeah, I guess, but then after a number of years of being a market maker, like I said, I got into the teaching side. I started teaching classes for the exchange, and that was the first time that I ever really interacted with anybody who wasn't a professional trader, which is 99.99% of people who are actually using options. And it was interesting. I kind of found that I could provide a lot of value giving the perspective of a professional trader to people who are not professionals but are trying to learn and trying to get better at doing what they do.
Well, 2,500 disciples is quite a number, and I know you continue to build on that number. So let's start talking about what I think is just such a critically important topic for all options, traders, investors, and that is, what option strike, what month, how does an investor go about? I mean, what do we have? 900,000 different strike prices, lots of months. We got the weeklies. How does an investor, narrow the focus? What is your process for choosing a strike, choosing a month?
Yeah, I feel like that's a really important thing to talk about. I was actually just putting a class together on this very thing. I think it's really essential to start out with knowing what your objective is. I
want to make money.
Look at a chart. Yeah, yes. It helps to narrow in a little bit more, on the issue at hand. But I think when you first look at a chart and do your research and look at fundamentals, whatever it is your technique is, that kind of gives you an idea of what you're expecting to happen in the forecast. You start with your forecast, and then that guides your decision as to, what expiration cycle should I pick? Well, that's somewhat contingent on my time horizon, and it kind of also helps me control my Greeks. If I'm putting on a short option position to capitalize on time passing, I probably want a shorter term option because I have higher time decay then. So that's definitely going to guide your expiration cycle, but it also guides your strikes too. If I'm looking at a credit spread scenario because I observe support or resistance on a chart, where I set my short strike would be contingent upon where support or resistance is. If I'm looking at a long option strategy, like a breakout scenario, that's going to guide my strike selection also, because I tend to want to go through my long strike to maximize the best gamma, the best bang for my buck, if you will. So I teach our students to always start with their forecast and basically let the market tell them what to do. Let the forecast guide the strategy.
And let me kind of take a step back. We've got somebody who doesn't know a darn thing about options and doesn't really know how to make a forecast on an underlying. Then what?
Sure. Well, I mean, look, when anybody first starts out in options, they don't know how to come up with a forecast. You have no reason to. It all starts with education. It starts with taking that first step, learning a little bit, sort of learning what I should even be thinking about, what I should even be looking at. So that's where it starts.
And if you had to say, and you may have kind of said it earlier, but just for people who are just starting, they got a blank canvas, they don't know a darn thing. Where do they start?
Well, I mean, there's plenty of educational resources out there, like, for example, the OIC, like, for example, Market Taker Mentoring. And there's plenty of books out there. I mean, I feel like I don't really care where people start their foray into learning, but the learning is the first step. Like, that's really the important thing. I'll tell you what, I talk to thousands of traders a year, and it is such a common story for somebody to come to me and say, well, geez, I lost my shirt trading options. And I say, oh, well, tell me, what was your process? How did you go about it? He said, well, some guy at a cocktail party told me they were great. So I went and I bought 100 calls and I lost everything. Like, you have to start out with a little bit of a fundamental basis. Like, you wouldn't start out a business knowing nothing about how that business runs. And,
right.
And trading is a business.
Indeed it is. So, all right, if you've, started to work on, 1, 2, 3 things that, you're going to kind of do some homework on, and then where does the overall market come into play in terms of a bias towards, maybe what strike, what month? Does the market in general come into play?
Yeah, I mean, I think with any retail-based strategies, and when I say retail, I mean that in the class, how brokers think about traders. Basically, retail trading means almost everybody basically anybody who's not a professional. And so, looking at the underlying stock, looking at direction of any individual stock, or your bias on any individual stock is essential. I mean, that's part of your forecast. But we also have to consider that when the market in general is very, very strong or very, very weak, that's going to weigh on individual names as well. And basically, it's the concept of beta. I mean, all stocks have some relationship to varying degrees to the underlying market. So, yeah, even if you're looking to set up a trade in Apple or Tesla or IBM or whatever, you still need to look at the market in general, because that's going to affect any individual trades.
Sounds good. And listeners, if you're not familiar with beta, do check that out, please. Another thing, Dan, you kind of mentioned in your example of the 100 long calls, where does the element of risk come into play with this process of, picking what strike, what month? Is it part of the process?
Yeah, risk is part of the process from before you make the trade to when you're making the trade to after you make the trade and to when you exit the trade. Risk is part of the process the whole time through. You're always sort of thinking about that and thinking about it in a very methodical sort of way. The analogy that I like to use sometimes and use on our Options Bootcamp radio show is, when you get into a trade, you always kind of need to know where you're going with it. You need to know what your exit is going to be before you get into a trade, much like you don't just get into a car and start driving and say, well, where am I going? Well, let's figure it out now. You're putting on a trade because you have an objective. You have a forecast. You think the stock is going up, for example, so you bought a call, but what's your target? Because you could buy a call and too much time passes and the stock can go up and you can lose on theta and it doesn't work out unless you have a methodology, unless you have a plan. So I think if there's one very simple takeaway for the question on risk, it's basically before you even enter into a trade, always know where I'm going to get out for a profit, what's my profit target, and where I'm going to get out for a loss should the trade go against me. You stick with that rule, I think you're doing pretty darn good.
Human nature being what it is, I think, at least my experience in talking to folks, a lot of times, they have a target, but they don't stick to it. What's your experience?
Yeah, I mean, that is very, very difficult. It is human nature and human psychology to, well, I don't know. I mean, I guess let emotions get the best of you sometimes. Nobody likes to lose money, and when a trade does go against you and you're losing money, you can panic and get out at a terrible price that wasn't part of your plan, or get kind of greedy and say, well, it'll probably come back. I'm going to ignore my plan, and then everything can get worse from there. So that's why when you have a plan from the get-go and you just write it down, we tell people just write it down on a piece of paper or in a Word document or whatever. And then I know, if it gets to here, this is what I'm going to do. That's what the logic said before I put on the trade. I know I'm scared or greedy or nervous or worried. That doesn't matter. I've got a logical plan. It's right here in black and white, and I'm going to follow it.
Well, a lot of it, it sounds pretty straightforward. Just like you say, you wouldn't start a business without knowing something about it. In terms of the size of that business, or in our discussion, the size of a position, do you want to touch on that? How do investors know, what the right size of a position is? I mean, for those just getting started, each option corresponds to 100 shares of the underlying, and so there's a lot of leverage in the whole option space. What are your feelings about size of a position, Dan?
Yeah, now this is a really great discussion point, because the answer is not really very intuitive. I think what a lot of people like to do is they like to say, I'm going to trade 5 contracts at a crack. That's going to be my risk control. But that's not really very practical, because 5 contracts of one sort of trade is nothing like the risk of 5 contracts of a different sort of trade. And that's kind of intuitive, even if you're talking about just buying a stock. If I'm buying 100 shares of Ford Motor Company, it's going to cost me $1,000 or something. That's my risk. If I'm going to buy 100 shares of Google, that's $100,000. I mean, those are 2 very, very different trades. And you wouldn't think of investing in stocks by, considering how many shares you're buying. You think about it on basically your risk, how much you're investing. So I think you kind of have to do that with options as well. And the best way to think about it is return on risk. Like, what is the margin that I'm putting up, which is in many cases conducive with how much you can lose. Now, it's not a universal rule, but it's a pretty good rule to start with. Look at how much margin you're posting. Look at how much risk you have, and quantify it in dollar terms more that way. Because then, if you're used to selling, or if you're used to buying maybe like a 10 lot of a butterfly, that might equate to a 1 or 2 lot of a cash secured put or something like that. So, yeah, I guess that's really the best way to look at it. Look at it in terms of how much am I risking on this trade, as opposed to how many contracts or what my credit or debit is or anything like that.
Okay, that makes a lot of sense. One last thing I just want to ask you, since we have the opportunity to talk. You're talking to investors all the time. Is there a most common mistake that you see coming from investors?
Well, I guess there's a handful of more common mistakes. I guess really, though, the biggest one is people not preparing themselves for trading and not really getting that education first. I'll tell you what, I spend probably half my time working with students sort of deprogramming them, like they try and figure it out on their own. They develop very bad habits. And I have to go back and say, whoa, wait, how come you're doing it this way? They say, I've always done it that way. If you do it this way instead, you have less risk and better reward. And they say, oh, okay. And so it's a lot easier to learn properly. Just, read a couple books, take a couple of months to get the process down, and then jump in before jumping in, losing a bunch of money to the markets and trying to fix something that you broke from the beginning.
All good pieces of advice, Dan, both in terms of strike price selection, how far out in time, and then the idea of size. Dan, we always appreciate you offering your wisdom. Thanks for joining us today on Strategy Spotlight.
Thanks, Joe. Thanks for having me.
It's time to meet the movers and shakers from the world of options. It's time for Profiles and Perspectives.
Joining us today on Profiles and Perspectives is Carolyn Leonard, founder and CEO of DyMynd. Carolyn, thanks so much for making the time to join us today.
It's my pleasure, Joe. It's always great chatting with you.
Well, I agree, and I think our listeners will agree as well. Why don't you tell them why don't we get started by just talking about your career path in what is obviously this male-dominated industry?
I started trading at the Chicago Board of Options Exchange out of a really nasty first marriage. And fortunately for me, I lived in Chicago where we had all these exchanges, and I happened to live in a neighborhood that had an awful lot of traders that had just moved in. The neighborhood I was living in was primarily made up of business professionals and doctors and lawyers, and all of a sudden all these traders started moving in. And it was like, oh my gosh, these guys, they have the greatest careers in the world. They were Board of Trade traders, and they would start work at 9 o'clock, 9:30 in the morning. They were through at 1:30, and they could afford to live in this fancy neighborhood. I thought, oh my God, does anybody else know about this? This is amazing. And because I was going through a divorce, I thought to myself, I think I'm going to go down to one of these exchanges. It seems to me like this would be a great place to start a career. Now, I had no background in commodities, but I did understand stocks. So when they told me that the Chicago Board of Options Exchange traded options on stocks, I thought, oh my gosh, this is for me. That's where I'm going. So I looked around, and I found one of my girlfriends was married to an option trader, and she introduced me to her husband, who invited me to come down to the Chicago Board of Options Exchange. Now, this was in the 70s.
And what pit?
About 3 years.
Do you remember? Remember which pit?
Well, the pit this gentleman was in the 3M, the Control Data, and the Commonwealth Edison and General Foods pit. But when I came down there, he showed me all around the floor, and so I met an awful lot of other traders. And the thing that was overwhelmingly, that struck me really, very hard was the fact that there were no women traders. When you stood above and looked out on the floor from the steps, it was a sea of men, and it was a lot of activity. Trading floors. There was all the yelling, the screaming, papers all over the floor. And as I descended the stairs and walked down on the floor for the first time, it was like, oh my God, I'm at home. These are my people.
Good for you.
And no, I loved it. I loved everything about it. I loved the excitement, and the stimulation was overwhelming. I just thought it was the greatest place.
And that's not because it was just all men.
No, well, that was being a woman and being divorced. That wasn't a bad idea, but
Okay.
it certainly wasn't because it was all men. In fact, because it was all men, and exists today, there's a lot of unconscious bias. Women had not been, there were women down there, but they were either exchange employees or they were brokers that had public paper. So these women didn't have the obstacles I had as a trader, because when you walk into a pit and you say, I'm going to trade here, you become competition. And no matter how much they may like a lady or a gentleman, when it comes to trading and money, nobody wants to divide the pie with another slice out for somebody else. So there was an awful lot of, early on, there was an awful lot of trying to block me from getting in on trades, which was fairly normal. It's open outcry. He who's first gets what out of the order. And
right.
So it was a very, very competitive environment, and one that fortunately, I was well suited to engage in and play on that trading floor for 21 years.
That's absolutely fantastic. And then, we fast forward, and here, you decide to create DyMynd. What motivated that? What's the focus for, your firm?
Yeah. Well, DyMynd, which doesn't stand for the stone. Now, we know diamonds are a girl's best friend, but DyMynd actually stands for Dynamic Minds, and it's spelled DYMYND. And I started thinking about this in 2007 and 2008 because of the market crash. And the thing that really struck me and made me understand that there was a tremendous need for financial empowerment for women was that, having been a working woman, most of my friends were successful working women. And during the market tumble or crash, if you want to call it that, about early 2009, all of a sudden I had friends, women who'd worked for 30 years, coming to my house saying to me, I don't understand. I have half the equity I had a year or 2 years ago. I've worked so hard. Am I going to be okay? And they were coming literally with bankers' boxes of statements. And those statements weren't from years. Those statements were from maybe 3-4 months. And what I understood was that all of these women, no matter how successful they were, didn't have a trusted financial advisor. And they had they had a lot of redundancy in their accounts, and they had an awful lot of what we call today, and we have a measurement of it, a low emotional financial security, which means that they thought at any moment that some event could occur and they would be bankrupt and homeless. And in those years, that seemed to be a very real feeling.
It sure did.
And so I knew, right, for everyone, I really think. And being women, I understood that one of the reasons they had so many accounts was they didn't have one trusted advisor. So they had redundancy in their accounts. I mean, I have one friend that had over 30 different brokerage accounts. And it wasn't because she wasn't looking for an advisor. She was actively looking. She just didn't find somebody that she felt she could totally trust. So she had money scattered all over the place. So out of that, I decided that there had to be a way to help women and help the industry better understand female clients, because I really think that there is a communication problem between financial advisors and their female clients. And that I know that the values women have around money is very different than perhaps a man would have. And we did a lot of research on this. And being women, the women we talked to had an average net worth of about $3.5 million of investable assets, all the way up to over $100 million. And almost every single woman that we talked to had a certain level of dissatisfaction with their financial advisor and with their institutions.
Well, you said something in there, Caroline, about, we did a lot of homework. Tell me about who the we members of your team are.
Well, my partner is a PhD. Her name is Monica Black. And Monica, we went to New York, and we went and sat in on a roundtable discussion in Manhattan where the average net worth of the women in the room of investable assets was over $35 million. And when I sat down there, and Monica was really cute because she said to me, I never would have thought that women with that kind of wealth had the same problems I have, and with financial institutions and with advisors, and that all of their feelings around how they were being treated around their money was very similar to hers. So Monica Black is my partner. Then we have Jessica Darmoni, who's just fabulous, who does all of our marketing, and then we have a great web designer, Derek, and my original founder was a guy named Tomer Yogev. He's an MBA, and he still helps with thinking through some of the strategy and stuff like that. So we have about 6 people on our team, and everybody is just really passionate about empowering women around money. Now, when we did the research, we called our roundtable discussions Money and Merlot. So when it came to inviting women to come to our roundtable discussions, we had no problem.
I just said, what about the white wine drinkers? Just teasing you.
Oh, we had that too. We had Prosecco. We weren't discriminating. No. And what was interesting is that after the women went through and they answered our questions, and we asked every group the same question, a lot of the women, because they had never been as open or honest discussing money, said, well, we've got to get together and we've got to go to dinner. And so they actually, from a focus group, formed little dinner clubs where they meet a couple of times a year and they go to dinner and they continue to discuss money.
Oh, interesting. There's obviously, no matter what the net worth, there's a lot that these people who you're touching have in common. So that actually makes an awful lot of sense to me. Before we wrap it up here, 2 things, I guess I'd like to ask. Number one, key takeaways that you would like our listeners to think about today. That's number one.
Well, to me, the key takeaway is that for most people, I know the industry thinks everybody makes rational decisions surrounding money. It's been our experience and our research shows that when markets are smooth and there's low volatility, people are rational. But with volatility, a lot of irrationality and a lot of fear enters into it. And so one of my key takeaways is that when it comes to your money, be very aware that you really do have feelings, emotions tied into it. And you really want to weigh any decisions you're making in the heat of market volatility. You want to make very careful decisions at that point in time and be well-reasoned.
And the last thing I want to ask you, Caroline, and it's obviously very important for our listeners, how can they contact you?
They can go to our website, www.DyMynd, DyMynd.com. And if you want to email me directly at cleonard, Leonard, at DyMynd.com. And I look forward to anybody contacting me. I'm passionate about this, and I learn what I know.
Well, Caroline, it's always great to talk to you. Founder and CEO of DyMynd, and we look forward to seeing you in Chicago one of these days. Thanks so much, Carolyn.
Thank you, Joe. It's great chatting with you. Have a great day.
Bye.
It's time to upgrade your options toolbox with cutting-edge trading platforms, devices, and information. It's time for tools, resources, and good reads.
In today's tools, resources, and good reads, I'll start with a tool that is useful all year round, not just in tax season. It's the Qualified Covered Call Calculator, which can be found on 21st Security Corp's homepage. That homepage address is www.20-first.com. The calculator is on the right side of the homepage under Investment Tools. There's also a link under Tools for how are your index options taxed. So there are a couple really good, tools and pieces of information here. And again, that's the 21st Security Corp's website at www.20-first.com. Today's resources may be one I've mentioned before. It's the website for iVolatility. There are all kinds of interesting option data and tools there, much of it free, some available for a small fee. You can find all this information on the iVolatility website at www.ivolatility.com. And our good read today comes from our Strategy Spotlight guest, Dan Passarelli. Dan has written a few books, But the one I want to highlight today is trading option Greeks, how time, volatility, and other pricing factors drive profit. It's an excellent read. Do try to check it out. That's today's Tools, Resources, and Good Reads.
It's time for a nostalgia break. It's time to take a look back.
In today's Looking Back, we're going to cover 3 different listener questions. And actually, I really enjoy getting these questions and then getting a chance to talk to you about them. So keep them coming, please. First question today comes from Butcher Boys. The question is, what options trading strategy would you say is best suited to people with zero knowledge of options? Well, Butcher Boys, before you get involved with any option strategy, I would strongly suggest you spend some time on option fundamentals. Who has rights? Who has obligations? How many shares of stock does each option correspond to? Understand the difference between a call and a put, in the money, at the money, out of the money, exercise and assignment. That's less than 10 concepts. Please study these, get to know the concepts, then come back to me and we can talk about an appropriate option strategies. Today's second question comes from Bullseye 7. And the question is, are options worth it for day traders or just swing traders? Well, let me start by defining the difference between a day trader and swing trader. A day trader is one who buys and sells the instruments they are trading with a one-day time frame. There may be lots of buying and selling, but by the end of the day trader has no position on his books. The swing trader time frame is about 3 to 5 days to hold a position. That's the difference between the two. So back to your question, are options for day traders or swing traders? Well, my opinion is options are far more appropriate for the swing trader. And even that time frame, 3 to 5 days, is very aggressive to open and close a position unless you're trading specific news like earnings announcements. Options have 5 different pricing factors, all of which can impact one another. Those pricing factors can remain static or change abruptly, so there really is complexity in options pricing. Now, stocks or futures, on the other hand, only have price impacting value. So those instruments, only with price as the variable, are far more appropriate for the day trader and even for the swing trader. Many, and I would dare to say most option positions are held beyond the time frame of even a swing trader. Today's third question comes from Krashen, 1975. His question is, which of the Greeks do you utilize the most and why? Well, let's start by listing the Greeks. Delta, Gamma, Theta, Vega, and Rho. I'm not going to define each. If you're not sure of, what the Greeks are, you could, check out our website, optionseducation.org, or Google them. That's Delta, Gamma, Theta, Vega, and Rho. Now, without question, the Greek I utilize the most is Vega. Vega is the Greek that quantifies premium levels in an option. That's premium levels in an option. What could be more important than the premium levels? In my opinion, nothing is more important than quantifying the premium levels, and that's what Vega does. A quick review of option price. If an option is in the money, it has intrinsic value. Quick example of that. Take a $50 stock. You've got the $45 call, which is the right to buy stock at $45 with the stock at $50. You've got $5 of in the money or intrinsic value. Anything above that $5 is time value. And that time value component is largely derived from Vega. Back to our $50 stock. The 50 calls are at the money. The entire price of that option, the 50 call or the 50 put, is time value. Same with the 55, 60, and 65 calls if they have that many strikes. Also, it's the same thing with the out-of-the-money puts. the 45 and 40s. All of these options have no intrinsic value, just time value. And Vega is the key Greek, valuing that premium. That's why, to me, Vega is the most important and the one I utilize most. One more thing. You can check out our volatility charts on our website at optionseducation.org. It's a combination of implied volatility and historic volatility. Again, you can find those charts, which I consider invaluable, at optionseducation.org. Thanks for your questions today. That's Looking Back.
Investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, Characteristics and Risks of Standardized Options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell a security or to provide investment advice. You've been listening to the Options Industry Council's Wide World of Options. If you have questions about anything you heard on today's show, email Joe Burgoyne at options@theocc.com. Or you can call OIC's Investor Services at 1-888-OPTIONS. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu. Or join their group on LinkedIn. Thanks for listening, and be sure to check out our next episode of the Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.